You want to own a rocket company? Great. Just bring at least $1 billion, patience measured in decades, and a taste for watching expensive metal explode on livestream. Because the weird truth is this: the thing that looks like the business is often not the business. Launching rockets is the flashy part. In many cases, it is also the part that loses money. So the real question is not, can you build a rocket? It is, can you survive long enough with enough scale to make the rest of the economics work? That is the trap. A rocket company can look like a futuristic printing press for cash, when in reality it may be a giant machine for converting investor money into smoke, software updates, and regulatory paperwork. Let's start with the entry ticket, because this is not a coffee shop where you lease a counter and open next month. If you want to enter the orbital launch game in any serious way, you are usually talking about at least $1 billion just to develop a basic, functional orbital rocket. That is the low end. If you want to go big and build a heavy lift system like Starship, you are looking at more than $15 billion in raw capital before the first official commercial flight. That is not a startup budget. That is, please do not ask me for a napkin and a business plan money. And even after you spend it, the cash flow problem gets uglier. Rocket hardware has to be built months in advance. Engines, tanks, avionics, launch systems, testing, and range operations all eat cash before you ever get paid in full. Customers often pay in milestones, not giant upfront checks. So you can be technically busy, operationally advanced, and still financially underwater for years. Now here is the part most people get wrong. Rockets themselves are not necessarily the profit engine. Launch revenue sounds sexy, but the economics are often brutal. SpaceX's 2025 disclosures showed its core space launch segment lost $657 million. That is not a typo, and it is not a rounding error. The part that makes the headlines can still be a money pit. So where does the money actually come from? Three main places. First, government and defense contracts. Second, commercial satellite customers, including companies that need large payloads moved to orbit. Third, rideshare missions, where many smaller satellites split one launch. That sounds efficient because it is efficient. A single rocket can carry a bunch of tiny customers instead of waiting around for one giant customer to show up. But the real profit engine, at least in the SpaceX style model, is broadband and data connectivity. Starlink generated $11.4 billion in revenue and $4.4 billion in operating income in 2025. That is the sugar daddy in the relationship. The launch business helps, but the recurring connectivity business funds the expensive dream of building and flying rockets at scale. If you ever wondered how a company can keep launching metal into the sky while burning cash in one division, that is how. The cost structure is where this business gets mean. Up to 70% to 80% of costs can be fixed. That means launch pads, testing facilities, engineering salaries, software teams, safety systems, environmental studies, compliance, and a regulatory machine that never seems to sleep. Those costs show up whether you launch one rocket or 20. Then there are the variable costs. If your rocket is not reusable, this is where the math gets ugly fast. You may be rebuilding a brand new vehicle worth around $60 million for every customer mission. That means each flight has to carry a huge share of the company's annual burden just to avoid turning into a very expensive hobby. Reusability changes the game. Once a rocket stage is flown multiple times, the fuel cost can be only a few $100,000 per launch. That is a massive drop in marginal cost. It is why reusable systems can move gross margins from deeply negative territory to something like 35% to 50% on a strong flight profile. Not guaranteed, not automatic, but absolutely possible if the system is flown often and the hardware survives repeated use. That if matters, because the real money in rockets is not just building something that flies. It is building something that flies often enough to spread those fixed costs over a large number of missions. And this is where the industry gets a little ridiculous. SpaceX flew 165 Falcon 9 missions in 2025, and nearly 3/4 of them were delivering its own Starlink satellites. In other words, the company is one of its own biggest customers. That is not a bug. It is the model. It's like a delivery truck company that keeps paying itself to move boxes to its own warehouses. Very efficient if you can finance the whole circus. The market structure also matters. SpaceX controls roughly 82% of the US launch market. That is a heavyweight position, and it tells you something important. This is not an even fight. Competitors are not all trying to win the same slice of pie. Some are trying to survive long enough to bake a new pie entirely. A lot of that pressure comes from pricing. The cost to send 1 kilogram to orbit has fallen from about $65,000 in the shuttle era to under $3,000 today. That sounds great for customers and terrible for weak competitors. Rocket companies are aggressively reducing their own launch pricing power in order to keep launch frequency high and squeeze out rivals. In normal businesses, you raise prices when demand is strong. In this business, you often slash prices to buy market share and usage volume. That is a bold strategy when each mistake can vaporize $100 million of hardware in a very public, rapid, unscheduled disassembly. And yes, that risk is very real. One software issue, one loose bolt, one overlooked engineering problem, and the rocket becomes a fireball with a launch date. That can wipe out not just the hardware, but the schedule, the customer trust, and the next several months of cash flow. In a restaurant, a bad day hurts sales. In rockets, a bad day can destroy years of work. The other hidden monster is regulation. You do not simply decide to launch because the weather looks pretty. Environmental reviews, safety reviews, range approvals, and federal oversight can delay operations for months. If your entire business model depends on cadence, then bureaucracy is not an inconvenience. It is a balance sheet event. So what does a real owner scenario look like? Suppose you have the billion-dollar entry capital for a smaller orbital launch operation. You build the vehicle, the pad, the test infrastructure, and enough staff to actually fly. Now you need working capital, a lot of it, because you will be paying engineers, range fees, insurance, compliance, manufacturing, and maintenance long before the launch revenue becomes reliable. If your mission mix is mostly one-off government or commercial flights, revenue may be lumpy. You can have a huge quarter and a quiet one. If your hardware is reusable and your flight cadence is high, the economics improve dramatically. If not, you are stuck in a capital-intensive cycle where every new launch is partly financed by the last one. This is why flight cadence is everything. If you launch twice a year, you probably go bankrupt. If you launch twice a week, you have a chance. High frequency is not just a growth metric, it is how you amortize those fixed costs across more paying payloads and keep your team, infrastructure, and investors from panicking. And the winners usually do something else that looks boring, but matters enormously: vertical integration. The strongest operators build their own engines, chips, software, valves, and key components in-house instead of depending on slow, expensive aerospace subcontractors. That gives them speed, control, and the ability to iterate after failures without waiting on a vendor timetable. In this business, waiting is expensive. A month lost to a supplier can be a month of payroll with no launch revenue. That is one of the deepest reasons the business is so hard to copy. You are not just buying machines, you are building an industrial culture that can design, test, fail, fix, and fly again faster than everyone else. Now for the payback question, because this is where most fantasy versions of the story die. There is no quick ROI here. A realistic investment payback period is often 10 to 15 years, and that assumes a lot goes right. The rockets have to stop exploding, the regulatory environment has to cooperate, the customer base has to scale, and the company likely needs a second, more stable revenue stream like broadband or in-orbit services to finance the whole operation. If you only own the launch business, the payback can be worse, much worse. A launch-only operator with low flight frequency and no recurring revenue is basically a very expensive engineering project pretending to be a company. The stronger scenario is the integrated model: launch plus recurring orbital services, such as connectivity or infrastructure. That is where the math starts to resemble a real enterprise instead of a science fair with a giant burn rate. The weaker scenario is the standalone launcher that depends on a handful of contracts and has to reinvent its cash flow every year. That business is one failed launch away from a very awkward board meeting. So is owning a rocket company attractive for a typical business owner? Absolutely not. For a normal investor, this is a financial nightmare. The capital requirement is enormous. The working capital drain is relentless. The operational risk is extreme. The regulation is slow. The hardware is expensive. The upside depends on scale that most owners could never finance. And the resale value of a custom rocket company, if things go wrong, is not exactly comforting. You cannot liquidate a failed orbital infrastructure business like you can unload a chain of coffee shops. This only makes sense for an eccentric billionaire, a sovereign-scale investor, or a founder with near-religious conviction who is willing to treat the company like a mission rather than a conventional profit-seeking asset. That is why people like Elon Musk or Jeff Bezos can play this game. They are not just buying a business, they are underwriting a civilizational bet. If you are a normal person looking for a smart investment, rockets are almost never the answer. The economics are too unforgiving, the time horizon is too long, and the hidden capital needs are too deep. The launch business looks like the product. The real product is scale, vertical integration, and another business somewhere else paying the bills while the rockets learn not to explode. That is the weirdest thing about owning a rocket company. The money is not in going to space. The money is in surviving Earth long enough to make space profitable.